Every empire believes its money will last forever, but history keeps proving otherwise. From Portugal's real to the Dutch guilder, from the British pound to today's US dollar, every reserve currency follows the same predictable pattern, and every one of them dies the same way. 7 steps, 6 centuries, 4 currencies down, 1 now standing on the edge. The United States dollar became the world's reserve currency in 1944 at the Bretton Woods Conference, where nations agreed that global trade would flow through the dollar. It was the moment America's economic empire began, and, mathematically speaking, the clock started ticking. Because every reserve currency has a lifespan, and the dollar's has already outlived most of them. On average, global reserve currencies have lasted 80 to 110 years before collapsing. The dollar has reached year 81, and all the warning lights are flashing. The trade deficits, the endless money printing, the loss of industrial dominance, the quiet global shift toward gold and alternative settlements, these are not random events. They are stage 6 symptoms, the same that destroyed every reserve before it. The question is not whether the dollar will follow the cycle. The question is whether anyone can stop it. Tonight, we break down the 7 steps every reserve currency takes before it dies, and reveal exactly where the dollar sits right now. Every reserve currency begins the same way, not with banks, not with trade, but with military dominance. Control the oceans, the choke points, and the arteries of global commerce, and you control the flow of wealth. The first currency to master this rule was the Portuguese real in the late 15th century. While most of Europe still clung to coastal navigation, Portuguese explorers were crossing open oceans, rounding the Cape of Good Hope in 1488 and breaking the Ottoman monopoly on overland trade routes. They didn't just explore, they conquered. Fortified outposts at Goa, Malacca, Macau, and Mozambique became floating tax stations for global trade. Every ship that passed through those waters paid tribute, and every transaction required Portuguese currency. The real became valuable not because it was backed by gold, but because it was backed by cannons. The Dutch guilder followed the same blueprint 2 centuries later. The Dutch East India Company, VOC, was not a company in the modern sense. It was a private empire with its own army, navy, and right to wage war. With 40 warships and 20,000 soldiers, it took over the Portuguese trade routes, captured the Spice Islands, and built Amsterdam into the center of world trade. The guilder became the universal medium of exchange because Dutch guns and fleets made it impossible to trade without them. By the 19th century, Britain perfected the model. The Royal Navy ruled the seas with more warships than the next 5 nations combined. Control of strategic choke points like the Suez Canal, Gibraltar, Singapore, and the Strait of Malacca gave Britain a stranglehold on global trade. Britannia rules the waves wasn't just a song, it was economic law. The pound sterling became the world's reserve currency, not because Britain produced more wealth than others, but because it controlled the routes through which all wealth moved. When World War II ended, the pattern repeated one final time. The United States emerged as the only major power with an intact navy, intact industry, and global military presence. The US Navy, with its 11 carrier strike groups, became the enforcer of post-war trade. America didn't just defend sea lanes, it owned them. From the Persian Gulf to the Panama Canal, every major maritime choke point had an American base nearby. If you wanted to move goods, you moved them under American protection, and that meant doing business in US dollars. Stage 1 is the foundation of the cycle. Military dominance creates economic demand. The world's merchants need your currency not because they choose to, but because they have no other option. It's the beginning of every reserve currency's reign, and the root of every empire's illusion of permanence. After a nation secures control of global trade routes, the next stage begins. Wealth flows inward. This is the golden age of every reserve currency. When exports dominate, trade surpluses explode, and the capital of the empire becomes the financial center of the world. For Portugal, this began in the early 1500s. when spices, silk, and porcelain flooded into Lisbon from Asia. A single voyage to the Maluku Islands could return profits of over 1,000%. Portugal wasn't inventing wealth, it was redirecting it. Asian goods bought for gold and silver were resold in Europe at 10 times the price, and the crown's share of the profits was enough to fund its government without heavy domestic taxes. The empire's treasury overflowed, but its power was built on control, not production. By the 1600s, the Dutch Republic had perfected this model into a science. Amsterdam became known as the warehouse of the world. Everything, Asian spices, American silver, African ivory, passed through its ports. Dutch merchants didn't just trade goods, they arbitraged the globe. They bought low in one market, sold high in another, and kept the spread. The result was staggering wealth. By 1650, Amsterdam's canal houses symbolized a society where merchants were richer than kings. The Amsterdam Exchange Bank standardized transactions, making the Dutch guilder the most trusted currency in Europe. In the 19th century, Britain took this surplus model to industrial extremes. The Industrial Revolution turned the island into the workshop of the world. Britain exported textiles, steel, machinery, and ships to every continent while importing cheap raw materials from its colonies. The global balance of trade tilted toward London, and the pound sterling became the backbone of global finance. The City of London managed more capital than the rest of Europe combined. Britain wasn't just trading goods, it was exporting its currency, its credit, and its confidence. Then came the United States, repeating the same cycle with unmatched scale. From 1945 to 1970, America ran the largest trade surpluses in human history. The rest of the world needed US goods, cars, steel, electronics, and they paid for them in dollars. Those dollars then flowed back to American banks as global reserves. Fort Knox held over 20,000 tons of gold, more than the rest of the world combined. This surplus made the dollar unstoppable. The world didn't just use it because America demanded it. They used it because they needed it. Stage 2 is the height of prosperity. The nation's industries dominate, its currency is trusted, and its exports enrich both the state and its citizens. But hidden inside this success is a fatal flaw. The surplus never lasts. Over time, wealth breeds comfort, and comfort breeds complacency. Factories give way to finance, and production turns into speculation. That transition is the first crack in the foundation of empire, and the beginning of stage 3. Every empire reaches a moment when its dominance is no longer informal, it's codified. That's stage 3, when the world officially crowns a nation's money as the reserve currency. It's the ultimate symbol of power, but it's also the beginning of decline. Because once the world depends on your money more than your goods, your economy begins to hollow out from within. For Portugal, this formalization came in the early 1500s. After decades of controlling trade routes from Africa to Asia, European and Asian merchants began settling international contracts in reais. Treaties, maritime agreements, and taxes were denominated in Portuguese currency. It was the first true global money, and the moment Portugal stopped seeing trade as an enterprise and started seeing it as a right. A century later, the Dutch guilder rose to the same position. By the 1600s, Amsterdam's financial markets were the most liquid on Earth. Bills of exchange, loans, and international treaties were all written in guilders. The Dutch East India Company, itself richer than most European states, functioned as a private central bank. The guilder wasn't just a medium of trade, it was the denominator of global credit. But power built on finance is fragile. Once a nation's wealth flows more from lending than producing, its foundations begin to shift. For Britain, the turning point came in 1815, at the Congress of Vienna. With Napoleon defeated and the Royal Navy unchallenged, the world adopted the pound sterling as the standard of trade and finance. The gold standard that followed in the 19th century was effectively a pound standard, because Britain held the gold and set the rules. But this moment of triumph also marked the start of what economists later called the Triffin dilemma, though it wouldn't be defined until the 20th century. The dilemma is simple. To provide the world with enough of your currency to use as reserves, you must run trade deficits. But running deficits eventually weakens your currency's value. It's a trap no empire has escaped. For the United States, that trap was set at Bretton Woods in 1944, when 44 nations agreed to make the US dollar the global reserve. Other currencies would peg to the dollar, and the dollar would peg to gold at $35 an ounce. It was the most powerful financial agreement in modern history. The dollar became the center of world trade, energy, and debt. But from that moment forward, America had to export dollars, not goods, to sustain the system. The trade surpluses that once fueled its power began to vanish. Stage 3 is the moment of maximum prestige and the moment of irreversible change. The world stops demanding what you make and starts demanding what you print. The surplus that made you rich transforms into a deficit that will, eventually, bring you down. By stage 4, every reserve currency nation believes its wealth is self-sustaining. Trade surpluses fade, factories slow, but confidence remains, because the world still needs its money. That illusion allows governments to live far beyond their means. The shift is subtle at first, from producing goods to consuming them, from earning wealth to borrowing it. And once that transformation takes hold, it never reverses. Portugal entered this stage by the mid-1500s. Flush with gold from Brazil and slave routes from Africa, Lisbon became addicted to imported luxury. Grain came from Sicily, textiles from Flanders, weapons from Northern Europe. The empire's spending soared, palaces, churches, and fleets funded by bullion, not productivity. As long as ships from the colonies kept arriving, the crown believed it was rich. But the gold wasn't income, it was liquidation, the selling of its own future. The Dutch Republic followed the same script in the 1700s. A century of massive trade surpluses had made Dutch merchants unimaginably wealthy. But with that wealth came complacency. The sons of traders became bankers. The nation that once ruled the seas began lending money to others who still worked them. Amsterdam turned from a trading hub into a financial hub, generating returns through interest, not industry. It's the same pattern seen centuries later on Wall Street, a nation mistaking paper wealth for real prosperity. By the early 1900s, Britain was deep in the same trap. Once the workshop of the world, it now imported most of its food, raw materials, and even manufactured goods. British investors no longer built factories at home. They owned mines in Africa, railways in India, and shipping companies in Hong Kong. The profits were immense, but they came from extracting wealth abroad rather than creating it at home. The empire's economy became financialized, its deficits papered over by centuries of accumulated capital. Then came the United States. In 1971, President Richard Nixon severed the dollar's link to gold, the Nixon shock, ending the Bretton Woods system and removing the last restraint on debt creation. For the first time in modern history, a global reserve currency was backed by nothing but confidence. From that moment, deficits became permanent. America began importing far more than it exported, paying for foreign goods with paper dollars that the rest of the world still accepted as valuable. By the 2000s, the annual U.S. trade deficit had reached nearly $800 billion, the largest in history. Yet the system kept working because everyone needed dollars to trade. Stage 4 is the comfort phase, when an empire's strength becomes its weakness. The world demands its currency no matter what, so it prints freely, borrows endlessly, and mistakes debt for dominance. But every deficit has a cost. When printing replaces productivity and finance replaces labor, the collapse of value is no longer a question of if, only when. Stage 5 is where the illusion of endless prosperity starts to crack. Governments have spent too long living on borrowed money, and the debts have grown too large to manage through taxation or productivity. The only way out, at least temporarily, is to debase the currency. Historically, That meant shaving silver from coins or mixing gold with cheaper metals. Today, it means expanding the money supply until the currency itself becomes the product. Every reserve currency has reached this stage. None have survived it. For Portugal, the decline began in the 1550s. Facing mounting deficits and falling trade revenue, the Portuguese crown started reducing the silver content of its coins. The real, once respected across continents, was quietly diluted. Prices soared, merchants demanded more coins for the same goods, and trust in the currency began to fade. By the time Spain annexed Portugal in 1580, the real was little more than a symbol of past glory, its purchasing power gone. The Dutch guilder, once the most stable currency in Europe, followed the same path in the 1700s. Wars, colonial costs, and debt forced the Dutch government to abandon fiscal discipline. They began printing money to cover deficits, flooding the economy with paper notes that outpaced real production. By the 1780s, Amsterdam's reputation as the world's financial capital had vanished, and merchants had shifted their trust and their gold to London. For Britain, debasement came through inflation and devaluation rather than coin tampering. The two world wars forced the government to print vast amounts of money and suspend the gold standard twice. Each time they returned to it, the pound was weaker. After World War II, Britain was bankrupt. In 1949, the pound lost 30% of its value overnight in a single devaluation. Another followed in 1967, further eroding global trust. By the early 1970s, the pound sterling was no longer the world's reserve currency. It was a regional one, its empire reduced to history. Then came America, and this time, the scale was unprecedented. When the US ended the dollar's convertibility to gold in 1971, the printing press became the engine of the global economy. The promise of gold was replaced by the promise of confidence. The result was predictable. In 2008, facing the financial crisis, the Federal Reserve printed $3.5 trillion in new money under the name quantitative easing. In 2020, the pandemic triggered another printing wave, over $7 trillion in just 2 years. The dollar's supply exploded, and with it, inflation returned. Between 2020 and 2023, the US dollar lost roughly 25% of its purchasing power. But because the dollar is still the global reserve, the pain didn't stop at America's borders. The Fed exported inflation to every country holding dollars or dollar-denominated debt. When the US debases, the world pays the price. This is the unique danger of the modern system. One nation prints, but everyone bleeds. Stage 5 is the breaking point of confidence. The currency still rules, but the cracks are visible to anyone who looks. And once trust in money itself begins to erode, the next phase arrives quickly. The world starts looking for a way out. Stage 6 is the reckoning, the moment when the world begins to doubt the empire's money. It doesn't happen overnight. Confidence erodes quietly, trade by trade, year by year, until one day the same governments and central banks that once hoarded your currency begin to sell it. That's when the countdown to collapse begins. For Portugal, that moment came in the late 1500s. After decades of debasing the real, merchants across Asia and Africa began refusing Portuguese coins. The same traders who once lined up at Lisbon's ports demanded Spanish silver instead, the pieces of 8 minted from the mountains of Potosi and Zacatecas. The real, once the symbol of Portugal's dominance, had become worthless outside its own borders. The Dutch guilder followed the same fate in the 1700s. As Amsterdam's financial empire overextended, other nations began to move their reserves to London, where British naval and industrial might offer a more stable alternative. By 1790, the guilder was no longer the global medium of trade. It was a relic used mostly within the Netherlands. Confidence didn't collapse in a single event. It drained away, quietly but completely. For Britain, the collapse was faster and more public. After World War II, the empire was broke, dependent on American loans, and unable to defend its overvalued pound sterling. In 1949, Britain devalued the pound by 30% overnight. Holders of British currency, governments, investors, and citizens lost nearly a third of their wealth instantly. Another devaluation followed in 1967, confirming what the markets already knew. The pound was finished as the global reserve. Within a decade, the US dollar had fully replaced it, and now history is repeating in slow motion with the dollar. After decades of printing, deficits, and debt, nations have begun diversifying away from the greenback. China and Russia have slashed their holdings of US treasuries, converting their reserves into gold. Saudi Arabia, once the linchpin of the petrodollar system, began accepting yuan for oil sales in 2023, breaking a 50-year precedent. Across Asia, new trade agreements now settle in local currencies, baht, ringgit, rupee, rather than dollars. The numbers tell the story. In 2000, the dollar made up 72% of global foreign exchange reserves. By 2024, that figure had fallen to 58%, a loss of over $3 trillion in market share. Each percentage point that vanishes is a silent vote of no confidence. Central banks around the world are buying gold at the fastest pace since the 1970s, preparing for the same pattern that has repeated 4 times before. This is stage 6, the search for alternatives. The dollar still dominates, but dominance isn't the same as trust. Confidence is the oxygen of every reserve currency, and right now, the world is learning to breathe without the dollar. Because when trust is gone, the next stage begins, the final phase of the cycle that no empire has ever escaped. Stage 7 is the endgame, the moment when a once unshakable currency becomes history. No empire ever believes it will happen to them. Every empire says this time is different, but the pattern has never failed, not once in 6 centuries. When confidence dies, replacement begins, and collapse follows faster than anyone expects. For Portugal, the fall came with brutal clarity. By the 1580s, the real had lost so much value that merchants refused to trade in it altogether. Spain's silver peso, minted from the endless mines of Potosi, took its place as the global medium of exchange. Within 20 years, the Portuguese currency was irrelevant. Lisbon, once the center of world trade, was reduced to a colonial outpost of Madrid. The Dutch guilder met its end in the late 1700s. The British pound was rising on the back of industrial production and naval supremacy, while the Dutch economy had become a financial shell. The transition wasn't dramatic, it was inevitable. By 1815, after the Napoleonic Wars, London had replaced Amsterdam as the financial heart of the world, and the pound had replaced the guilder as the global reserve. The Netherlands remained wealthy, but its money, its power, was gone. Then came Britain's turn. Exhausted by 2 world wars and buried in debt, it watched as the US dollar replaced the pound between 1944 and 1960. The handover was formalized at Bretton Woods, where the world's leaders agreed to anchor the global economy to the dollar. When the pound was devalued again in 1967, the illusion ended. The British Empire's financial rule had lasted just over a century, 105 years, almost exactly matching the lifespan of the currencies before it. And now, in the 21st century, the dollar stands where the pound once stood, in Stage 7's shadow. The US currency remains the backbone of global trade, but its dominance is eroding, one transaction at a time. The BRICS nations are building a competing financial system. The petrodollar arrangement that forced the world to buy oil in dollars is unraveling. Digital currencies, gold-backed settlements, and regional payment systems are quietly taking its place. The process is slow, invisible to most, until it isn't. When a reserve currency dies, it doesn't fall to zero. It simply stops being necessary. The world no longer needs it to settle trade or store value. Demand collapses, prices spike, and the issuing nation faces what it has exported for decades: inflation. For ordinary people, it means savings evaporate, imports soar, and the illusion of wealth disappears overnight. It happened to the Portuguese merchant, the Dutch banker, the British pensioner, and soon, it may happen to the American saver. Stage 7 isn't just the death of a currency, it's the transfer of power from one empire to the next, from one printing press to another. The dollar won't vanish tomorrow, but its replacement has already begun. The cycle that started 6 centuries ago is closing once more. Every reserve currency lives the same story: rise, dominance, decline, replacement, and every empire learns the same lesson too late. Every empire believes it will be the exception. The Portuguese did, the Dutch did, the British did, and now, so does America. Each thought their money was eternal, their system too advanced, their dominance too secure. Yet every one of them followed the same 7 steps: from power to privilege, from privilege to complacency, from complacency to collapse. The pattern never changed, only the names. The Portuguese real lasted 80 years, the Dutch guilder 80 more, the British pound just over a century. The US dollar has reigned for 81 years, and it now stands exactly where its predecessors once stood, in stage 6, on the edge of stage 7. The warning signs are no longer subtle: endless deficits, record debt, money printing on a scale never seen before. Nations diversifying away from the dollar, central banks hoarding gold. The same moves made centuries ago by those who saw the end coming. But what makes this cycle different is scale. When Portugal fell, the world continued trading. When Britain fell, the dollar was ready to replace it. When the dollar falls, there is no single successor. The system itself must be rebuilt. The next reserve currency might not belong to a nation at all. It could be a basket of currencies, a digital standard, or a commodity-backed hybrid designed to survive a world too interconnected for one empire to dominate. But whatever form it takes, the transition will not be painless. Every currency collapse redistributes wealth from the unaware to the prepared, from those who trust the system to those who read the pattern. History shows that reserve currencies don't die in panic. They die in disbelief. The collapse happens slowly, then all at once, and by the time people realize the system they trusted no longer works, the next one is already in place. The question isn't if the dollar falls, it's who will be ready when it does, and what comes after. Because every empire writes the same final chapter. They rise through trade, rule through debt, collapse through arrogance, and leave behind a system designed to repeat the cycle. The dollar's story isn't ending. It's becoming the preface to the next one.